Going live now.
All right, can everybody see my presentation okay? Great. Well, good afternoon, everybody. My name is Chris Roop, and I'm a fiscal analyst with the Legislative Joint Fiscal Office. I am new to Vermont and new to JFO, and I look forward to working with all of you as this session unfolds. Though my focus is mostly on transportation issues, in a previous life I served as a trustee on the City of Philadelphia's pension board, so I also work on pension issues too. So pensions are going to be a topic of conversation this session, so the speaker thought it would be helpful to give all members an opportunity to learn a bit more about the key issues involving pensions, particularly since not everyone has the same level of experience with them. I'm not an actuary or an investment professional, and our time together is limited, so I'm going to try to keep this rather high level today. My goal here is to have some follow-up sessions that then take a deeper dive into the specific challenges facing Vermont's pension systems, how we got here, and some possible paths forward based on what other states have looked at. But today, I want to make sure you all have some foundational understanding about what pensions are, how they work, and some of the overall issues. I'm sure you'll be hearing more from the treasurer and others on these issues in greater detail in the near future as well. But if I say anything that is confusing or that triggers a question, please don't hesitate to ask. I also know some members here have some experience dealing with these issues in prior legislative sessions. So if I cover a point you think is worth elaborating on, or if I omit something you think is important, I would certainly not be offended if you speak up and contribute to this conversation so your colleagues can benefit from hearing from your perspectives. So this is just a quick overview of the difference between defined benefit and defined contribution plans. In a DB plan, a defined benefit plan, the employee receives a retirement benefit that is defined by an established formula. The amount you get in retirement benefit is based on the formula, not based on how well the investments perform. In a DC plan, a defined contribution plan, instead of receiving a formula-based benefit, the employee receives a formula-based contribution amount from the employer into a retirement investment account, often with a required match from the employee. With a DC plan, the employee's overall investment performance and savings rates determine how much money they will have for retirement. In other words, the risk falls more on the employee than on the employer. There are other alternative plan designs out there, like stacked hybrids or cash balance plans, which incorporate different features of DB and DC plans. But today we'll be talking about DB plans. Generally speaking, a DB pension fund is designed to pre-fund future retiree benefits by investing contributions from employers and employees, and then using gains from those investments to help pay for retirement benefits. Vermont has three major statewide public sector pension systems: VSERS for state employees, VSTERS for teachers, and VMERS for municipal employees. Each of these three systems is governed by a board of trustees and managed by the state treasurer's office. And all three are defined benefit plans, although a defined contribution option is available for some exempt state and municipal employees. For today's discussion, I'm going to focus on the first two plans, the state employees and the teachers, because the municipal system has some fundamental differences, and it isn't in the same condition as the other two systems are. This chart shows you a few more details about the three plans. The average annual benefit paid to a retiree is around $21,000 under both VSERS and the teacher plan. And both plans are relatively mature. In other words, there are a lot of people receiving benefit payments compared to the number of active employees paying into the system but not yet receiving a benefit out of it. Those two plans work and look quite a bit different than the VMERS, the municipal system, which is why I'm going to just focus on the state employee and the teachers for now. So as I mentioned, with a DB plan, the employee's retirement benefit is defined by a formula. Each pension plan can look different, but generally this formula is based on a few key inputs: how many years of service an employee has worked, what their average final compensation was, and a multiplier percentage. Multiply those three elements together, and you will calculate the estimated pension benefit. Now, usually a pension plan will calculate the average final compensation by averaging somewhere between 3 and 7 years of an employee's highest consecutive years of salary to smooth out any spikes or irregularities from one year to the next. Plans will also often cap how large your base pension benefit can be relative to your average final compensation. For example, some of Vermont's plans cap the pension benefit at 50 or 60% of AFC. Another key factor includes determining when an employee is eligible to retire and start collecting a benefit. You'll hear the words normal retirement and early retirement a lot. To reach normal retirement, typically an employee must reach a minimum age and or combination of age and years of service, whichever comes first. When you hear the words rule of 87 or rule of 90, it means that an employee who might not be 65 years old yet can still qualify for a normal retirement if their age and years of service total 87 or 90. So here's just a quick generalized example to show you how the math works. Let's say I'm a hypothetical state employee who's 65 years old with 20 years of service, and my average final compensation worked out to $66,000. What will my benefit be in normal retirement? If you multiply my years of service and AFC and the plan's benefit multiplier of 1.67%, you get an estimate of $22,044 in benefit each year. Another example here shows how the maximum benefit works by capping retirement amounts at a fixed percentage of AFC. This is a generalized example just to walk through the math. In reality, there are other factors like which survivorship option I choose that will influence what the actual amount of my benefit will be. So in contrast to normal retirement, many plans also allow people to retire early, meaning they can get a pension benefit even if they did not reach the minimum retirement age or rule. However, the early retirement benefit is usually reduced compared to what the employee would have earned if they retired normally. Another key calculation is this concept of a COLA, or cost of living adjustment. Some plans implement a COLA on retired employees' pension benefits to help their benefits keep up with inflation. Not all pension plans out there have COLAs, and COLAs can be calculated many different ways. And lastly, there's this concept of vesting in the plan. Not every employee will be automatically entitled to a pension benefit when they retire. Instead, the employee must work for a minimum period of time in order to qualify for a pension. This is called the vesting period, and it's usually 5 or 10 years depending on the plan. If you work for less than that period of time, you don't vest in the plan, you're not entitled to a retirement benefit out of the pension fund, and you'll have whatever contributions you made into the pension fund while working refunded to you. And here are just a few fun facts about how much both plans paid out in benefits and refunded contributions last year. I added 2 slides at the very end of this deck to show you the various rules and formulas that apply to calculating the state and teacher retirement benefits as well. I don't plan to spend a lot of time today discussing them in detail, but I wanted to provide you with the information as background materials. So now that we've covered how benefits, let's take a look at how pension systems work more generally. The great advantage to a pension plan is that when you pre-fund your retirement expenses, you can spread out these costs over time, and those assets can be invested and allow the plan to take advantage of compound interest and investment returns. The plan assets are invested according to an investment strategy, which is designed to achieve the expected rate of return over a long period of time. Each plan's investment strategy looks different, but generally these strategies try to accomplish a few key goals. You want to have a diversified and balanced investment portfolio. You want to try to manage your investment risk by creating a portfolio that can capture gains in the market while protecting your assets from losses, inflation, and downside risk. You want to minimize extreme volatility in your assets from year to year. And it's really important to remember to take the long view and avoid trying to time the market. Generally, pension funds invest in assets like equities or stocks, fixed income or bonds, private equity, or real estate. There are many different types of each of these assets, and there are some asset classes that I didn't mention. But the investment strategy and investment performance is periodically reviewed, and assets might be rebalanced as market conditions evolve. The overall goal here to keep in mind is that the pension investments should not be speculating or striving to bet on what's going to generate the biggest return that year. Doing so more often than not will increase the risk to the plan. Instead, the goal of the investment strategy is to prudently and responsibly achieve the overall expected rate of return over time. This slide visualizes how investment returns grow over time through compound interest. Let's just assume for the sake of this example that we invest $1 million at 7% or 7.5% for 30 years, and that the money consistently achieves that rate every year. After 30 years, that $1 million will grow to be $7.6 million if it grows at 7%, and $8.7 million if it grows at 7.5%. What this means in practice is that when a pension fund isn't adequately funded, the impact of that underfunding really grows significantly over time. If I took my $1 million and spent it on something else, instead of invested it in the pension plan, I did not cost the pension plan $1 million. In reality, I cost the fund that $1 million plus all of the compounded investment returns that million would have earned over the amortization period. With compound interest, time is your friend, and the larger the investment you can make in the near term, the larger the investment gains will be in the future. And further on this subject of prudently and responsibly investing the plan assets, it's worth touching on this concept of fiduciary responsibility. Pension plan trustees and the Pension Investment Committee have a fiduciary responsibility, which generally means that they have a duty to act in the best interest of the beneficiaries. In this case, the beneficiaries are the members and the retirees. This requires exhibiting a high standard of care and the need to act with prudence, impartiality, trust, and good faith. In other words, a trustee cannot pick and choose investments on a whim or engage in self-dealing. Their job is to responsibly try to maximize the plan's total return on investments within acceptable levels of risk. They need to always act in the best interest of the plan members. So let's just take a quick look at how these pension systems are governed in Vermont. All three have a board of trustees according to statute. The trustees, who are listed on the Treasurer's website, are responsible for the general administration and oversight of the pension system, and each board of trustees has at least 5 members. The Pension Investment Committee is responsible, or the VPIC you hear it called, is responsible for governing the investment of the assets of the retirement plans, approving the investment policy and asset allocations, and they appoint third-party managers and consultants. The Treasurer's Office is the custodian of the assets and manages the day-to-day operations of VPIC and the retirement systems, as well as manages the reporting, the studies, and recommends long-term policy. The Treasurer is a trustee of all 3 boards as well. The role of the investment consultant is to prepare performance reports, conduct the asset liability study, review investment manager performance, and they recommend investment managers for selection by VPIC. The investment consultant works for the pension funds, not for the money managers or for the people who try to pitch particular investments. The legislature's role includes appropriating the funding to pay the employer ADAC contribution, which I'll get into in a little bit, though the actual amount of the approved appropriation has sometimes been more or less than the ADAC amount. When a payment less than the ADAC is made, that can create an underfunding situation that causes the liability and ADAC to grow in the future. Remember, when less money is put into the system loses the opportunity to achieve those investment gains compounded year after year. In addition to appropriation powers, the legislature has established various reporting and procedural requirements in statute, codifies the elements of the retirement plan design into statute, and establishes the amortization schedule that determines how the unfunded liability should be paid down. The legislature does not, however, set the assumed rate of return or pick and choose specific investments. That work is the responsibility of the plan trustees and VPIC. So now that we have a refresher on some of these foundational issues, let's dive back into the issue at hand. Both the state and teacher plans are facing some funding challenges, and these challenges are due to a combination of factors that are not unique to Vermont. Both of the plans are relatively mature retirement systems with growing unfunded liability. When you hear someone say the plan is mature, what they mean is that the plan has been around for a while and there is a high ratio of retirees and beneficiaries who are receiving a benefit out of the system relative to the number of active employees who are paying into the system. At the bottom of this slide are some statistics to show the point a little clearer. You can see that the ratio of active employees to retired employees has changed over time. And there are now a lot more members receiving benefits out of the systems, while the number of active workers paying into the systems has held steady or declined. What this means in practice is that the employer is exposed to more financial risks in the form of higher contributions into the pension fund from changing assumptions or investment performance. It also means that it can be harder to significantly move the needle on improving the plan's funding status from year to year, since the fund has to pay out a lot of assets every year that could otherwise be left to grow in the investment market. Over the years, investment performance has not consistently achieved the plan's assumed rates of return. Again, not an issue unique to Vermont. The assumed rate of return means exactly what it sounds like. It's the annual investment growth rate that the plan assumes it will achieve over time. The plans have also lowered their assumed rates of return recently, which I'll talk about more on the next slide. I also want to note that while the legislature has a strong recent track record of making the required payments into the pension system and even payments in excess of that amount, this was not always the case throughout history. In fact, many plan sponsors nationwide reduced their pension contributions over the years, especially during tight budget times. Doing this, however, creates a hangover that lasts for years because the pension system does not get to realize any investment gains that it would have if the full amount of money was paid into the fund at the appropriate time, and the impact is compounded each year. I want to note that demographic and experience factors have increased pension costs substantially as well. People are living longer, and things like salary growth rates, COLA rates, and employee turnover rates are all factors that influence the future costs of the retirement system. Now, there's also a second level challenge around funding the state's other post-employee benefits, like retiree healthcare. This is a fast-growing liability, and it's worth its own separate discussion. Let's talk briefly about the assumed rate. Vermont's pension trustees recently lowered the assumed rates of return for the funds from 7.5% to 7% to more realistically match projected investment gains. It's generally a prudent course of action to have an assumed rate of return that can be realistically achieved through the plan's investments. But there is a cost to doing this, which I'll speak to in a minute. Vermont is not unique in doing this. In fact, the trend nationwide has been for pension systems to lower their assumed rates of return, as this graphic on the slide from NASRA shows. Almost half of the plans surveyed by NASRA now have an assumed rate of return of 7% or lower, and the vast majority assume a rate lower than 7.5%. This trend is driven by many factors: years of pension plans failing to achieve higher rates of return, lower inflation rate experience and projections, and just generally lower expectations for investment gains in future years. A more conservative assumed rate of return is easier to achieve with the investment performance and leads to more realistic assumptions, but it also leads to higher ADAC payments into the pension fund in the near term. So the bottom line is that all of these factors have contributed to the fact that these two pension systems do not have enough assets today to fully pay for the costs of the retirement benefits they expect to pay out in the future. The difference between the future costs or liabilities of those retirement benefits and the value of the assets in the plan is referred to as the unfunded actuarial accrued liability. You'll just hear me call it the unfunded liability. The unfunded liability essentially represents that shortfall to fully pay for promised retirement benefits. For both VSERS and the teacher plan, the unfunded liability is growing more rapidly than the assets in the plan are growing. This means that the funding ratio for the plans is decreasing, and the funded ratio is another key metric of pension health. These two graphs show the trends a bit clearer. Here you can see the impact that the Great Recession had on the value of assets around 2009. Up until that point, the plans were in relatively healthy shape, with funding ratios above 90%, and that gray liability line wasn't too far above the orange asset line. But since the recession, that gray liability line has increased at a rate faster than the orange asset line has increased. The unfunded liability equals that space between the gray and orange lines, which has also grown. As the unfunded liability grows, the funding ratio declines, as seen on the blue bars. Interestingly, this has all happened while the state has been fully funding its required ADAC payments into the pension system since 2007. So unfunded liabilities are extremely common in defined benefit pension plans, especially more mature ones. The mere existence of an unfunded liability is not necessarily a cause for concern, but if that unfunded liability grows too large, it will create some real challenges to manage through, because that unfunded liability ultimately must be paid off over time, and the funding status of the pension systems can really impact the state's bond ratings. The way we pay this liability off is through a process called amortization. It works similar to your home mortgage, where you spread the cost out over a period of time and pay it back in installments with principal and interest every year. The longer your amortization period, the lower your annual ADAC payment will be, but you will pay more in total and continue to have a significant fixed expense draining your budget for more years. But a key difference between the pensions and your mortgage at home is that the principal amount with pensions is subject to change based on plan experience, changing assumptions, and investment performance. Amortization can work different ways. For VSERS in the teacher system, there's a closed amortization system, meaning that the full unfunded liability is scheduled to be paid off by an established time period, by 2038. What all of this means in practice is that when the unfunded liability goes up, more money must be paid into the pension system. The payment the employer should be making every year to pay down the unfunded liability in accordance with the amortization schedule, along with the employer's share of the normal cost, is called the ADAC, or Actuarial Determined Employer Contribution. It used to be called the ARC. If the unfunded liability is your outstanding mortgage payment, or your outstanding mortgage balance, the ADAC is your mortgage payment that year that you need to pay in order to pay the mortgage off on time. Now, generally in a conventional DB plan, the active employees typically pay a fixed, pre-established contribution rate out of their paychecks into the pension fund. The employee contribution rate is not automatically linked to any changes in the unfunded liability. Instead, the risk for making up funding shortfalls or paying for the higher ADAC is borne by the employer, in this case, the taxpayers. Some plans do have risk-sharing models in place where employee contribution rates might change based on the performance of the pension fund, but this is the conventional model. So typically, at least every 5 years, pension systems engage actuaries, study their workforce data and their investment performance and strategy, and use those inputs to revise their assumptions for how much future retirement benefits are going to cost. This is usually referred to as the experience study. The most recent projections, plus the reduction in assumed rate of return from 7.5 to 7%, have translated into significant growth in the unfunded liability for both pension plans. As a result of this growth in liability, the projected ADAC payment has also increased. Generally speaking, the larger the unfunded liability, the larger your ADAC payment will be when all other assumptions are held constant. In plain language, this means that the total cost of future retirement benefits grew based on projecting out from today's plan structures and recent employee and investment experience. And the pension plans expect that less of the money needed to pay for those benefits is going to come from investment returns in the future. Therefore, the employer's payment toward those costs, the ADAC, will increase in order to make up the difference. It is important to note that despite what anyone may say for whatever reason, you cannot avoid paying off the unfunded liability by moving all employees from a DB to a DC plan. That liability represents a contractual obligation to pay for retirement benefits that past and current employees have earned. But you can take steps to lower the unfunded liability in ADAC by making changes to plan design for active employees who are still working but not yet retired, as well as applying those changes to future employees. Let's look at a few more numbers. These charts show how the ADAC has changed in recent years for both plans. You can see that it's a pretty significant jump in costs in just the last few years. And the increase between FY21 and the recommended FY22 level is substantial for both plans. And again, the ADAC amount represents what the employer should pay into the pension fund that year to fully pay for the normal cost plus pay down the unfunded liability according to the amortization schedule. This slide summarizes the major challenge facing the state now. Everything I've just gone through translates into these numbers in bold. In a status quo situation, the actuaries determine that an additional $36 million payment is going to be due to the VSERS system and $60.6 million to the teacher plan next year in order to stay on schedule for paying down the unfunded liability. This increase is driven by the need to pay off an unfunded liability that also grew significantly through a combination of changes to experience, demographic, and investment assumptions. For VSERS, that liability grew $225 million, and for the teachers, it grew $379 million in just 1 year. So what drove such a big jump in the unfunded liability? It's due to a combination of factors, such as changes in actuarial assumptions, the rate of net turnover of plan participants, the salary experience of participants, and the past investment performance and assumed future investment performance for the pension plan assets. This table summarizes the impacts the various factors have had on that unfunded liability over the last 13 years for the state employee plan. The first column shows the cumulative impact of how the first column of numbers, the dollars, show how the various employee or the various experience factors and assumption changes impacted that unfunded liability. For our purposes here, a red or negative number is a good thing. Those are the things that reduce the unfunded liability. But you can see here how the assumption changes, various employee experience factors, and investment performance have had. The most significant factor was changes to actuarial assumptions, which included changes to the assumed rate of investment return. Together, these changes are responsible for over $480 million of the unfunded liability growth since 2007. Investment performance falling below assumptions increased the liability by another $317 million. And collectively, different demographic experience factors increased the liability by another $307 million. With these factors, the costs increased or decreased when actual employee experience deviated from assumptions. For example, people may have lived longer than assumed, or there were more retirements than assumed. The experience study is available on the Treasurer's website, and it includes further details about each of these categories, how specific assumptions changed, and what impacts those changes had in dollar terms. Here's the same data, but for the teacher plan. Similar issues are at play here, but with different impacts. Again, the experience study on the Treasurer's website has some additional details about these specific changes. A major difference here compared to the VSERS plan on the last slide is that line that says contribution shortfall, including healthcare costs. That line reflects the impacts of paying for healthcare for retired teachers out of the teacher pension system, a practice that ended in 2014. A key takeaway from both of these slides is that the unfunded liability didn't grow to any single factor. Rather, it's due to a variety of factors that, in the aggregate, increase the overall liability. We are looking at the combined impact from changes to forward-looking assumptions, investment performance that has not met assumptions, and workforce experience that has deviated from prior assumptions. So these are obviously pretty significant challenges to work through. In an effort to mitigate the near-term fiscal impacts of these projections, the Treasurer convened working groups to evaluate some possible options to lower the unfunded liability and ADAC back toward FY21 levels. She's been working with those groups, her staff, and the plan actuaries in recent weeks, and she's considered a range of options that would make adjustments to the design of the retirement plans for active employees who have not yet retired. The Treasurer issued a report on January 15th that presented the findings of this work, and I included a link here to that report. Through this process, a range of options to make changes to the plan formula were studied, including things like making changes to the COLA structure, modifying the number of years that are considered when determining your average final compensation, increasing employee contribution rates, moving all active employees to a rule of 90 in order to qualify for normal retirement, changing the number of years of service required to vest, and changing the maximum retirement benefit level. The Treasurer's report showed savings estimates for these various changes and recommended consideration of one overall scenario of options related to the state employees that gets close to the savings goals, but the report did not identify the same type of recommended scenario on the teacher side. The report did, however, include some specific recommendations to maintain a DB system, hold existing retirees harmless from any changes to the benefit plan structure, continue to fully fund the ADAC amount, and to the extent any federal dollars or excess revenues are available, dedicate more funds to pay down the ADAC and OPEB liabilities. I'm sure you will hear more from the Treasurer in the near future, but I think it's worth reading through her report. It's brief and easy to follow and presents some helpful context and numbers for those two plans. And in a future session, we're going to discuss some of those options in greater detail. So I know I put a lot of information before you at lunchtime on a Friday in the last few slides. So let's wrap it up to the main points. We're discussing pensions today because recent changes in assumptions based on employee experience, investment performance, funding history, and demographic and economic projections in the future have led to significant projected increases in the unfunded liability and ADAC payments for both plans from FY21 to FY22. For both plans, these increases are double-digit percentage increases over the current year and total up to a collective increase in the unfunded liability of $604 million for both plans and $96.6 million increase in the ADEC for both plans. As the treasurer presented in her report, there are a range of options to lower these costs through changes to the design of existing plans. But based on the numbers I've seen in that report, it's going to be a challenge to find any single option on plan design that will feasibly reach those cost reduction goals for either plan. There's just no silver bullet that makes this problem magically go away. Reaching those goals of reducing the ADAC and unfunded liability will require a mix of multiple options that are costed out and implemented together rather than in isolation. It's also going, in my opinion, to be an easier path forward to identify a range of options on the VSER side than on the teacher side, because the plans are very different. The hole is deeper on the teacher side, and the range of options under study do not generate the same level of savings for both plans. So I talked a lot today, and I appreciate you listening and bearing with me. For today's purposes, I wanted to make sure we all had a baseline understanding of some of the issues and how the different pieces fit together, so you can have a more informed review of the various ideas and proposals about pension issues. In the next installment, we'll take a deeper dive into the specific factors that brought those two pension systems to where they are today. Then look at some possible options and strategies that other states have used to deal with similar types of pension issues. Meanwhile, if you have any questions about anything I covered here today, please feel free to reach out and I'll do my best to answer them or find you the answer. Thank you.
Great. Thank you so much, Chris. I know people have some busy schedules, but if anyone has initial questions on the presentation that was just covered, we can open it up. We'd ask that you raise your hand. First, I see Representative Beck, and then we have Senator Pearson on deck. So Representative Beck, go ahead.
Hey, Chris. That's the second time I've seen that presentation, and it makes more sense this time than the previous. So I really appreciate it. It's a complicated subject. I don't have a question per se, but there's some information that I'm looking for, and maybe you could include it in some of your future presentations if you haven't already put it in there. But a big part of this whole restructuring is predicated on what investment rate of return the pension funds receive going forward. It seems like they've settled on 7. If you could include a history of how we've done in the past years, decades, just so I can start to get my head around what does 7% really mean, that would be greatly appreciated.
Absolutely. That will be included in my presentation next week.
Great. We have Senator Pearson and Representative Campbell on deck.
Thank you. Chris, I don't pretend to know a lot about the details, but as I understand it, somewhere in the 2010, 2012 range, maybe it was the rating agencies, or there was an accounting change that were made by folks with some authority over pensions across the country that sort of exacerbated how the numbers, how we think of the numbers, didn't necessarily change the reality, but changed the way we report it. Are you able to help us understand that, or maybe at another juncture kind of understand whether or not that impact is real, or just some of those details?
Sure, that's a great question, and I'm not an expert on the GASB accounting rules, so I'm not intimately familiar with anything that may have impacted pensions back then. I'm not sure if Representative Gannon or anybody else on the call may have more to offer. I can tell you that recent changes to the GASB rules have had an impact a little bit more on the OPEB side, the other post-employee benefit side, and the most significant change was that states now have to report their full OPEB liability separate from pension liability. And that was not always the case. And the impact of that rule has been many states, including Vermont, have seen very significant increases in their long-term liabilities on their balance sheets. So as a result, the state now has a negative balance sheet when you look at our comprehensive annual financial report.
No, I think Chris is right. I mean, the GASB changes impact OPEB. And I'm not aware of any GASB pension changes that had a dramatic impact in the last few years, but we can double check.
Thank you, Chris. Thank you, Representative Gannon. Representative Campbell, go ahead.
Sure, thanks. I was really struck by the increase in the number of retired and retiree beneficiaries in both the state employee side and the teacher side, and wonder how much of that drives the increase in unfunded liabilities. You said, Chris, that there's a range of factors that affect it, obviously, but I just did a quick calculation, and the increase just between 08 and 20 in retirees was on the state employee side was over 50%, and on the teacher side was like 70%. So that seems like a huge sort of structural issue, and it leads me to wonder whether if we were starting fresh, if we were designing a retirement system for people, whether picking a defined contribution system wouldn't be smarter just for that reason, just because of the growth in retiree numbers.
Sure. So that's an excellent question, and you're right to point out the impact that demographic trends have had on the fund. Further back in my slide deck, when you see the charts that just have the different factors and dollar values listed, you can see how net turnover and retirement experience has led to increased liabilities on both sides. And there are always people being hired and retired. The system makes assumptions based on that. What these dollar values represent is how the actual experience deviated from what we assumed would happen. So when you have more retirements or more turnover than you initially thought, many times that leads to an increase in your unfunded liability. And just more generally, assumption changes based on experience. This happens all the time. I mean, the pension funds do a valuation study every year, and they do an experience study every 5 years, really to see how well we did compared to our assumptions, and then reset assumptions going forward. So as part of that process, these numbers are always subject to change a little bit. I can tell you that the maturity of the plan, I mean, it's just due to demographic trends we're seeing in the state. It has been a pretty significant increase in the last decade. It hasn't just impacted the unfunded liability. It also means that whenever you're pumping more and more money into the pension system, it gets a little bit harder to move the needle on that funding ratio up, because you have to keep pumping out more and more money to make your benefit payments instead of having those dollars ready to invest in the long term and work for you. So it gets a little bit harder to dig yourself out of this hole. And as that trend goes up with more people drawing a benefit out, and the relative to the number of actives paying into the system, the risk to the employer can grow a little bit when your assumptions and your experience don't align with what you thought they were, and they drive higher payments up. It can result in more cost to the employer. But one other thing to keep in mind is when you have a lot of people collecting a benefit and your funding ratio keeps going down, that starts to change how you think about investing your assets. And you start having to prioritize protecting your principal from downside risk, because the fund can't afford to lose 10 or 20% if the market tanks. But generally, when you move to a less risk-averse investment strategy, that tends to come at the expense of investment gain. So that is a very long way of saying that trend impacts the pension fund in numerous factors.
Yeah, so I was looking at that chart that listed or table that listed the various impacts of the various factors that you talked about, and I couldn't find one that sort of isolated just the demographic issue.
Yeah, they're all broken out by specific demographic issues. So one says net turnover, one says mortality, one says retirements, disability experience, salary experience, COLA experience.
Yeah. Okay. Anyway, interesting point. But so, if you were designing a system from scratch, would it make sense to design as defined contributions so that the change in demographics was something that was absorbed sort of by the market rather than by the payer of defined benefits?
I think it depends on what you're trying to accomplish with a retirement system, and there are disadvantages to a DC plan as well. One big disadvantage to if you all had individual DC accounts, like a 401k, for example, is that your investment strategy isn't quite as efficient because you can't spread your investment risk over generations. So I'm 34 years old. I'm a really long way away from retiring. I can afford to have my money invested in more aggressive and riskier assets right now because I can let it ride. You know, I can weather the ups and the downs, and I'm not going to need that money. As I get closer to retirement and as I enter retirement, I would have to move my money into more risk averse asset classes because I want to protect the principal I have. I don't want to outlive my money, but that means I'm not going to earn as much in return. So a benefit of having a centrally managed plan like a DB plan is that you can spread that investment risk over generations and end up having a more efficient strategy by getting more investment returns. You know, the one advantage to, or the one difference, I should say, to a DC plan is you don't have as much risk at growing an unfunded liability over time.
Yeah, okay. Thank you.
Great. Next, we have Representative Page and then Representative Maslin on deck.
Yes, I was looking at the average benefits that you showed, a little over 10,000 and a little over 21,000. To me, they don't look like golden parachutes. Are there other costs that you're not showing here in these benefits? Thank you.
Now, these are just the average benefits that retirees are getting right now out of the systems, and there are two factors that Vermont has. You know, I think it is important to look at comparing what states look like, and I'm going to cover that in a future presentation. You know, it's hard to compare pension plans, and you need to make sure that you're comparing apples to apples because their overall compensation packages can look very different. So some states may not have Social Security coverage for certain employees, and the lack of Social Security coverage can be offset by what may look like a more generous pension benefit. So comparing classes of employee like that to one another is really important. It's also really important to look at this in the context of just your overall compensation package. You know, states that have a higher salary rate may end up having a higher, pension benefit rate or a higher cost of living. So, or some plans may have a higher base pension benefit, but a less generous cost of living formula. That's where I came from, Philadelphia. That's where we had it. So there are a couple key factors that are really interesting to compare, though, to see how generous plans are. One is, what's your benefit multiplier? Like, what percentage do you multiply your years of service to? Our multiplier is 1.67%. That is not, and we'll go into this in a future presentation, that's not one of the more generous multipliers out there. We also have a cap on your base benefit of either 50 or 60% of your average final compensation. That's relatively low compared to a lot of other plans out there. You know, the effect of that is, you know, you start after about 30 years of working, you're no longer increasing your pension benefit from working longer. You're only increasing your pension benefit through salary experience. So this can be a really difficult knot to untangle, but based on what I've seen from other states, and we'll go into this more in another presentation, the average benefits are not overly generous relative to other plans.
Great. We have Representative Maslin and then Representative McCoy on deck.
Yep. I guess I'm there. Thank you. The question I have, you said a few minutes ago about short-term investments necessary when you have to pay a lot of money out and longer term when you're trying to build a fund. Could you elaborate a little bit more about that? It's something I hadn't thought about, but it is clearly present these days. So I'd appreciate what you can say about that.
So I think the point I was trying to convey, and probably inarticulately, was as your funding ratio changes and you're pumping more money out in benefits, I wouldn't characterize it quite as short-term versus long-term. I would characterize it more as what's your tolerance for investment risk? And you may, as you are paying more out in benefits every year relative to contributions coming in, you tend to want to move your assets a little more toward things like fixed income or things that may give you a little more protection from downside risk and from losses. But when you do that, you're sacrificing higher investment returns that you can get from investing in different types of things like equities.
So it's tolerance for risk versus long-term money building strategies?
Correct.
Or okay, thank you. That's helpful.
Sorry, I was muted. Representative McCoy, go ahead. And then we have Representative Till on deck.
Thank you. Chris, has the plan looked at realizing people are living longer, but we are probably at the tail end of the baby boom generation. So going forward, there may be less people, are spread out over more years because I think we're almost at the end of a baby boom generation. Additionally, with a 401k DC defined contribution plan, historically state workers and teachers stay in their job for longer than, we hear now people stay in their jobs for 1 to 5 years and then move to another one. And then they can take their defined contribution with them. So what's your sense of that? I mean, in the end, a defined contribution may work as well for state and teachers because they would have that ability to take it with them. And additionally, there's less of a risk, I'd say, on the part of the state.
Great questions. Let me take the first one first. Yes, the plans do count for demographic projections in the future, and they project out based on workforce trends and assumptions in the future. What you're seeing, to your point about the baby boom generation, what you're seeing with that big growth in retirees and beneficiaries over the last decade is exactly that. You're seeing more and more people leaving the workforce and retiring, while there's the size of the active workforce has been pretty stable on the state side, and it's actually declined a little bit on the teacher side. So yes, the fact that the baby boom generation has been retiring over the last decade has definitely been a contributing factor to some of the demographic issues we see. On your second question, I'm not sure that I don't want to say that one plan is preferable to another. I will say that the public sector workforce, and you very rightly pointed it out, has a lot of fundamental differences in the private sector workforce. And I think what plan works best for employees depends on those factors and depends on the type of employee and where they are. So a lot of rank and file employees, as you noted in the public sector, they're career employees. They're going to be a public school teacher for 30 years. There are other people who may be at, either a sort of an executive appointee level or a department head type of level in the government where, maybe they're not in it for 20 or 30 years working at the same place. Maybe they are working for a shorter period of time and moving to another job. So I think having a mix of benefits that is attractive to all segments of the workforce is important for Vermont.
Thank you.
Representative Till, go ahead.
Thank you. Thank you, Chris, again for another excellent presentation. But if you said it, I missed it, so forgive me, but I didn't hear you talk about administrative costs and investment costs. Over the long run, those make a pretty big difference in your investment returns. And so I'm curious about what kind of costs we're paying, for making the investments and how our costs compare to other states.
Excellent question and excellent point. I did not go over that in this presentation, and we can discuss it in a future presentation when we start looking into investment performance history. You're absolutely right that you have to manage your costs because that drains your investment returns. And really, the impacts of really seemingly small charges to money managers can really add up and compound over time and drag down your overall investment performance. Many places, and the treasurer has done this as well in the last few years, have really taken a look at moving your assets to less costly options. And a lot of times that means getting out of more actively managed investment strategies where active managers don't have a consistent track record of generating better returns than the passive options do. So we have absolutely seen that happen in the state. Costs have gone down. There has been a move to do that. But I can go into some more detail on that, and that's something that we've just seen happening across the board.
Great. And recognizing the time, we have Representative Peterson, and then I think we will wrap at that point. So Representative Peterson, go ahead.
Thank you very much. And thank you, Chris. I'm a new legislator and I really have enjoyed this presentation. The defined benefits plan, I assume, needs as many paying in kind of as go out every year. I'm concerned with the teachers end of this as we see declining enrollments of students here. And so maybe less teachers are needed. So in the future, it would seem like less would be paying in than are paying in now, maybe. And I wonder what that does to the fund.
Excellent question. So it's not quite as simple as you have to have more paying in than getting a benefit, because there are other factors. The biggest one being, investment returns makes up a lot of the difference on your plan assets. And obviously, the more assets you have to invest, the more investment returns you have in the fund. Generally, in a mature plan, investment returns make up the majority of what you get in a pension benefit, not contributions. You are right, though, that over time, if we see this ratio change a little bit and a little bit more balanced, where you have where at least you don't see more and more people getting a benefit versus going in, it makes it easier for the fund to improve its health over time.
Okay, thank you.
All for joining us today, and thank you, Chris, for the presentation. As was previously mentioned, we have these scheduled for next Friday and the following Friday. And the House Government Operations Committee is taking on this work, and Representative Gannon will be taking the reins from moving forward with these meetings. So next week, we will have Representative Gannon helping to facilitate with Chris. So I hope everyone has a great rest of your day and a wonderful